Hi, I'm Roger Montgomery from the Montgomery Fund, and welcome to this week's Insight. The reporting season is not expected to produce an outstanding result for Australia's listed universe of businesses. The stock market has, however, become a little hot under the collar because it's one of the more attractive alternatives to the lowly rates of cash being produced currently. As an aside, property also seems to be unusually excitable if you haven't noticed already. By way of example, I heard over the weekend that a development at Bondi Junction here in Sydney, marketed by Legacy Property, sold 90 of their 93 apartments off the plan within 5 hours of release. In Sydney, it seems even if you take 85,000 people out for a fun run, you can't quite quell enthusiasm for property. That's the benefit of low rates. But it remains true that the higher the price you pay for an asset, the lower your return, and you'll need to tread carefully if you're investing now in Australian shares. For the record, I don't think the market is due for an imminent crash. Having said that, it probably now will. But the slow erosion of opportunity and returns could easily be another bath for investors. So what could end the party in Australian shares? Well, the two sandwich slices between which Australia's meat sits is obviously the US and China. For the US, there are two scenarios that could emerge as the reins on fiscal policy and quantitative easing are tightened. According to my good friend over at Magellan, Hamish Douglas, there's the orderly unwinding, which has the highest chance of occurring, according to him, and there's the disorderly scenario, which is the fat tail in the distribution of risks. The US Federal Reserve has three arrows in its quiver to taper the economy's addiction to the $80 billion monthly cash injection and bring back the $1.9 trillion in excess reserves that have helped the economy achieve the anemic growth that it now enjoys. Number one, raise interest rates. Only problem, if you raise interest rates to 2.5%, banks try to lend at 5%. Raise the interest rate to 5%, they try to lend at 7.5%. And guess what? It just doesn't work. Second choice, they could sell bonds, the bonds that they've bought over the last 4 years. Of course, selling $1.9 trillion worth of bonds might cause a bit of a hiccup in the bond market. So that's not going to work either. So the only option then is to raise the reserve requirement of banks, which currently sit at 1% of bank liabilities. Given the first two won't work, this one has to. An orderly exit from quantitative easing is dependent on a steady rather than fast recovery, and it requires that excess reserves are reduced gradually. With Bernanke jawboning the market and giving everyone plenty of time to get used to the idea, I reckon you can expect volatility irrespective of whether the exit is orderly or not. And if the economy accelerates quickly, it will be imperative that the Fed doesn't repeat the 1930s experience of taking too long to withdraw. This would produce the disorderly exit that would rattle share and bond markets as dollars flow out of emerging markets, producing a currency crisis in emerging markets and in Europe as well. The stronger the US economy, the greater the risk, but there's a bit of a wild card too. Of the two individuals most likely to succeed Ben Bernanke at the Fed, Janet Yellen is a bit of a socialist and has indicated already in her speeches that the Fed could decide to defer an exit of quantitative easing. Remember, that's a huge problem. She's cautious about exiting too early and has also suggested raising interest rates as a solution, and we know that won't work. Over at the Larry Summers camp, my friend Hamish reckons he should be called Larry the Lunatic. He thinks quantitative easing, the buying of $85 billion worth of bonds each month, has no effect on market pricing. He hasn't studied basic economics. So that's the US, but what about China? Well, we think much lower rates of growth are inevitable. Less fuel in the engine means less speed at the wheels. We've been talking about that for a long time, and despite the rally in our resource companies, we don't think that's changing anytime soon. So that's our insights, and I look forward to seeing you again next week. Be sure to follow us on Twitter and Facebook.